In this video, we are going to talk about why you should reinvest your dividends. So before starting this video, please like this video and subscribe to this channel for our future updates. Have you ever considered whether you should reinvest your dividends or take them outright and spend the money yourself? After all, reinvesting dividends in a bull market has the disadvantage of potentially reinvesting at higher stock prices. Perhaps taking cash dividends and investing them only in undervalued stocks makes more sense. Reinvesting dividends, on the other hand, allows investors to buy fractional shares, and some businesses with dividend reinvestment schemes also offer a discount on their stock. Although using a dividend reinvestment strategy, or DRIP, to reinvest dividends can be beneficial, it isn't for everyone. Let's look at when, and when not, you can reinvest your dividends. When it's a good idea to reinvest dividends. Automatically reinvesting dividends is my personal choice, particularly if you have a longer time horizon, 5 to 10 years, and mainly own high-quality companies with safe payouts. Dividend reinvestments help you avoid the temptation of trying to time the market by speeding up the compounding process. Continuously plowing capital into the market and adopting a hands-off approach is an established long-term strategy to compound your wealth if your investment period is long enough. As you can see, reinvesting dividends has provided the bulk of the market's historical returns. But, instead of taking dividends in cash, can't smart investors find just undervalued stocks to purchase, improving their returns even more? Regardless of how much we'd like to think otherwise, we're not just Warren Buffett's. It's not easy to know which stocks to buy at any given time, and the stock market is usually very effective. According to S&P Global, fewer than 8% of active fund managers have been able to equal, let alone beat, the S&P 500 over the last 15 years. It's difficult to predict which stocks would be the best long-term performers, which is one of the reasons we suggest equal weighting holdings and remaining well diversified when constructing a dividend portfolio. Simply put, automatically reinvesting dividends into the businesses that pay them is a smart way to extend your time in the market, avoid prejudices, and avoid being too cute with portfolio management decisions. The market's volatile short-term losses also help the case for a hands-off dividend reinvestment strategy. Since 1950, the S&P 500 has gone through 26 corrections, declines of 10% or more, and 10 bear markets, declines of 20% or more, from all-time highs. This equates to one correction every 2 to 3 years on average. The average fall in the S&P 500 during corrections from all-time highs was 21%, but 5 of those corrections saw losses of 30% to 60%. The market took about 1.7 years on average to return to a new all-time high, but there were 4 bear markets that forced investors to wait 3 to 7.5 years for a complete recovery. Automatic dividend reinvestment is a perfect way to dollar-cost average into ever larger positions during market downturns, allowing you to optimize the size, profits, and potential total returns of your portfolio. Knowing that your dividends will buy you more lower-cost, and therefore higher-yielding, shares will give you a nice emotional boost while also preventing you from making expensive mistakes like panic selling otherwise great companies at low rates. Finally, unlike placing a stock buy order through your brokerage, reinvesting dividends on autopilot allows you to buy fractional shares, maximizing the power of compounding. Some businesses would also give you a discount if you join their DRIP because it saves them money. Aqua America, WTR, a water utility, for example, allows plan participants to reinvest cash dividends in additional shares of the company's stock at a 5% discount. Without a dividend reinvestment strategy, these advantages are not feasible. However, while automatic dividend reinvestment is a powerful tool with numerous advantages, it is not always appropriate for all. Why you shouldn't reinvest dividends automatically. Dividend reinvestment isn't right for everyone or every situation for a variety of reasons. The first is asset allocation, or determining the best mix of cash, stocks, and bonds for your specific needs. Since bear markets are unavoidable, several financial advisors recommend keeping enough cash in your fund to cover many years of living expenses in retirement, unless your portfolio is big enough to enable you to live entirely off dividends. Maintaining a healthy cash reserve allows you to avoid selling stocks during market downturns, as required by the 4% rule. Stocks normally take 3 to 4 years to recover and reach new highs. Bonds can help provide income during this period, and they usually decline less during bear markets. In fact, They often rise as interest rates fall, and they can be sold more into a bear market to buy attractively priced stocks to rebalance a retirement portfolio. If your cash balance, think of it as an emergency fund that allows you to sleep well at night and remain calm through market downturns, has drained, taking your dividends in cash to replenish your reserve may be a good idea. It's important to note that the power of automatic dividend reinvestment is in increasing the share count over time, whether you're retired or not. While this approach works well for high-quality businesses that you want to keep for a long time, it will not work as well for dividend stocks. Selling your winners and keeping your losers is like cutting the flowers and watering the weeds, wrote Peter Lynch, eloquently expressing this idea. Investors could be throwing good money after poor if dividends are immediately reinvested into low-quality firms with unsustainable payouts. As you can see, S&P 500 companies that cut or discontinued their dividends delivered an annual return of -0.35% with high volatility, standard deviation, from 1972 to 2017, while the equal-weighted S&P 500 index gained 7.7% per year. To put it another way, it's difficult to make a convincing argument for investing in high-risk dividend stocks, let alone deciding to immediately reinvest the dividends they pay into additional shares. Some more daring income investors, on the other hand, choose to set aside a portion of their portfolio to invest in more risky income plays. It's important to keep an eye on your place size and overall diversification in these situations. Reinvesting dividends can result in a larger position than is desirable for your risk management rules. Buying more shares on autopilot raises the amount of money you're putting at risk if the company's fortunes take a turn for the worse. It's possible that taking the cash dividends and investing elsewhere is a safer option. Our dividend safety score system predicts businesses that are most likely to have their dividends cut in the future. Long-term investors can make smarter decisions on whether a stock is not only suitable for their portfolios, but also an attractive candidate for automatic dividend reinvestment by looking at a company's dividend protection. Finally, when it comes to investing, valuation is important. Investors who want to be more hands-on with their portfolios may take dividends in cash instead of purchasing shares in potentially overvalued stocks, and manually steer the money into more cost-effective investments. Automatic dividend reinvestments are price agnostic, which may be problematic if a stock tends to be significantly overvalued. A well-diversified portfolio, on the other hand, removes a lot of company-specific valuation risk, and, as previously said, the market is usually very efficient at pricing stocks. Building up a large enough cash reserve to invest in a possibly undervalued holding takes time and effort, and if you're not careful, it can lead to market timing. Dividend reinvestment is based on your needs and preferences. Dividend growth investing is ultimately about achieving your long-term financial objectives. Although reinvesting your dividends is a powerful tool for compounding your income and wealth faster, it isn't right for everybody or every circumstance. Unexpected expenses can deplete your cash reserves and emergency fund at any time. If you don't have other sources of income, you might want to replenish your cash position with dividends in the name of financial stability and sleeping well during the next bear market. Furthermore, while DRIPs can be a fantastic way to automate the investment process and thereby reduce the risk of making costly errors, protecting you from yourself, automatically reinvesting your dividends back into the companies that pay them has its own set of drawbacks. The dividend stock, in particular, could be a risky, high-risk investment that you can only hold a small portion of your portfolio, if at all, for the sake of proper risk management. Another risk factor is buying more shares in overvalued holdings. Overall, we tend to build a portfolio of high-quality dividend stocks that can be kept indefinitely as long as their dividends are secure and their long-term prospects are positive. Dividends reinvested around the board increase exposure to these companies. What do you think about our video? Have you ever invested in stocks, dividends? Let us know in the comments below. If you enjoy this video and want to hear from me again, be sure to hit that subscribe button and turn on notifications before you go. Thanks for watching.